Welcome everyone to our Forex for Beginners Essential Indicators Part 2. My name is Zino, and with me is Christopher Smilas, and very experienced trader. If you missed the last seminar, just visit our YouTube channel where you can find the Essential Indicators Part 1. Chris, please introduce yourself to everyone who's new to our
With pleasure. Thank you, Zino. I'm Christopher Smilas, Head of Sales and Training at SwapHunter.com. I've been a professional trader and portfolio manager for nearly 10 years, or just over 10 years now. I've worked with many different brokerages over those 10 years, and I've done a lot of due diligence by working with them, trading with them, investing with them, and so I feel very comfortable, being able to suggest and recommend brokerages for our viewers, clients, anybody who's attending this webinar, to register with them and open a trading account, demo account, live account, whichever it may be. So that's part of what I do. Also, being the head of training here at SwapHunter, what a large part of my job is basically to do these webinars. We host seminars and webinars. I do one-on-one training with some clients, and the purpose of this webinar is mainly for beginners, obviously, and what we're going to do is cover a lot, in detail about stochastics, okay, which is a technical indicator. We're going to cover moving average, convergence, divergence, and then we're going to have a look at Fibonacci's in great detail as well. And that should take us through the hour. I hope you enjoy what we're about to present.
Okay, before we start, just to get the technical part behind us, we're using the GoToWebinar platform. So if you want to interact with us, you can write your questions into the chat. You can do that anytime, and once in a while we'll have a quick look into the chat on our tablets and see if there's any questions out. And also, if you want to speak at the end in our open Q&A session, you can raise your hand. So you see on the GoToWebinar tool, you see like the bottom, that's the hand with the green arrow. That is to raise your hands.
But make sure your microphone is switched on. If you're going to raise your hand, that means that we'll see that you want to ask a question, and you will be able to speak live on the webinar and interact with us live. So make sure your mic's on.
Okay, very important is also the risk warning for Forex, because it is a risky investment, and basically our advice is do not invest money that you cannot afford to lose. This summarizes it pretty well, and now we're ready to start. Just if you're watching, we'll now shift more to the webcam, and the actual presentation you see you can minimize, because most of the action now is going to be on the webcam. So give me a second to just change. So now you should see our MT4 platform.
Yes, MT4, short for MetaTrader 4. It is the industry standard in the Forex world. Most brokers use it. MT4, MT5 came out a couple of years ago. Still, MT4 is the preferred platform for most people. So we're using an account here at Forex Cube. We're going to, Zino, if you could put a link on the chat for the registration link for Forex Cube. We'll get that up there so that you can register your details with Forex Cube, download a demo account to test it out, or indeed just go ahead and open a live account. And if you do that, by the way, we do have a promotion running at the moment.
Yes.
With Forex Cube. If you open a live account with €1,000 minimum, $1,000, euros or pounds, we will give you 3 months of free usage of the Swap Hunter indicator package, where I will also be training you and coaching you, give you a couple of free sessions. I normally charge for this, and obviously we charge for the software package. So yeah, so get yourself registered with that link that we just put on the live chat. Okay, so we're covering technical indicators this evening. So I just want to sort of summarize what they are. Technical indicators is what technical traders use, you know, for technical analysis. Okay, there's two types of analysis. You have technical analysis and fundamental analysis. Technical analysis is essentially mathematical calculations. You're using mathematics to study, and you know, you use these indicators that then calculate previous price action, historical price action, in order to predict future price action. Okay, so you're looking into the past in order to try and predict the future. Okay, so I also want to mention there's two types of technical indicators. We've got what we call in the industry a lagging indicator and a leading indicator. It might sound pretty self-explanatory, but I will give you the exact definition. Lagging indicators rely, they're sort of output oriented. What do I mean by that is that they tend to lag behind the price a little bit. So it's a little bit of a slower, well, it's a lagging indicator. Okay, so they rely on the output rather, and that means that it's harder to get an indication or a trading signal. A leading indicator relies more on input, sort of mathematical inputs or price action inputs. So it's they try to give you a more influence, or more make it easier for you to foresee price action, future price action. That's what a leading indicator is, and we'll go through one of those tonight.
Yeah, I'm just trying if I can get you the webcam actually on the main screen. Unfortunately, that is not working as wished. So yeah, just make sure that you maximize your screen for the webcam, yeah, to see everything. Good.
Okay.
Have a start.
All right. So what we're going to start off with is stochastics. Okay. So it is an oscillator, a momentum oscillator. Let me just find it in MT4 in my navigator panel. Stochastic oscillator. I'm going to left click, drag it onto my Euro US dollar chart. You see that we've got some parameters here. I will go through in a little bit more detail exactly you know, what a percentage K period is or percentage D period is. Okay, but the industry standard for stochastics is 14 on here. So I'm just going to type in 14 into this this window here, this field, and we've got an MA, which is a moving average. It's a simple moving average. You can use exponential, smooth, linear, weighted, but we're just going to stick with simple moving average, and click OK. And now we have our stochastic indicator or oscillator on our chart, overlaid on our chart. Okay, so essentially what stochastics are indicating or trying to show you is they're trying to generate signals based on overbought and oversold conditions on the market, but that might sound a little bit similar to relative strength index, okay?
Yes.
But there is a difference, and I will sort of go through exactly how they're different once I've summarized exactly what stochastics are.
Just a short reminder for you that missed the first webinar. There we explained the relative strength index, so make sure to watch the video, and yeah.
That's on our YouTube channel, so you can go ahead and just check that out if you missed it. So you can see obviously it's made up of two lines. Okay, so we've got a blue line and a red sort of dotted line here. I'd like to just sort of change the properties here, just sort of the visualization. I don't like this sort of dotted line. I want to make it a little bit thicker as well. These lines are a bit thicker. Perhaps it's easier for you to see It's most definitely easier for me to see. Okay, so we've got our sort of two lines here. Okay, now we've got the value of the oscillator, which is our red line. Okay, and then we have the blue line, which is essentially it's just a 3-day moving average. Now, the way that the value of the red line it's kind of a complicated calculation, so that's why I'm looking at my notes here. Okay, so it's calculated by using the closing prices of an asset within a specific range or period, which in this case would be 14 periods. Okay, which is what I changed our parameters to. Now we're only
just as a quick reminder, the periods depend on the time that you set. So if you are on a 1 minute chart or a 5 minute chart, it means 14 times that time range.
Period, that time range. So right now we're on a 1 minute chart. So the stochastic oscillator is calculating 14 minutes into the past in order to predict the future. So this is for a very short term. This would be for a very short term trader. I prefer myself, I'm a long term trader, position trader. I do some intraday trading, do some scalping, but I prefer to do my analysis when it comes to technical analysis, especially to use a day chart. So each candlestick now represents 1 day, so 24 hours is being represented by each candle here. So now the stochastic oscillator is calculating 14 days or 2 weeks back into the past, okay, which I feel gives you a more accurate or a safer sort of reading into the future. Now you can see as well that we've got the lines are operating within the range of 0 and 100. Okay, now 80 is generally giving you a sort of overbought reading, and 20 would be considered an oversold reading.
But just to ask as a stupid beginner, so the relative strength index, we have the 30 and the 70 as the level by default.
Yeah.
Now we have the 20 and the 80, which are showing the overbought or oversold. So what is the biggest difference between the relative strength index that we had last week and the stochastics?
Well, okay, so basically relative strength index is more based on actual price. Okay, what the difference is that the stochastic oscillator is more based on momentum. It's based on price speed, and the speed.
So you mean also the trading volume on a specific price level?
It does work on volume, but it's more about momentum. It's more about speed. Okay, so if we go into properties again into the parameters section, you'll see that we've got the percentage K period, which I may as well explain exactly.
The periods, yeah.
Well, it's a little bit more complicated than that. Okay, so basically. The percentage K, okay, so a 14 period percentage K would use the most recent close, the highest high over the last 14 periods, and the lowest low over the last 14 periods, okay? And it has a calculation, there's a formula, which we can put in a handout or in a sort of, I can explain it right now.
Well,
I'll just
probably for the beginners is too much just to understand the basics.
That's what I'm thinking. So the 14K period, which is essentially just the red line. Okay, this is making a calculation of the lowest lows, the highest highs within the period that we're setting up here, and the standard is 14. Okay, so 14 periods, and the blue line, which is the percentage D period, is essentially just a 3-day simple moving average of the percentage K period. Yes. Okay, so the percentage K, the red line is making calculations, quite a complicated calculation, you know, based on low lows, high highs, and then we have a 3-day moving average of that reading. Okay, so that's where it differs from relative strength index. It's more based on price momentum and price speed. Okay, and if it's speeding up or slowing down, and that's where it differs from RSI, where RSI works purely off price level. This is working on price speed and level. Okay, so momentum. So it's a little bit more complicated than relative strength index. Plus, stochastics is actually giving you signals, trading signals, with crossovers. Okay, so converging and diverging crossovers. So when we see the speed of the stochastic crossing over the percentage D reading and the percentage K reading, or the blue line and the red line. So when the blue line crosses through the red line, we're seeing that price action is speeding up. Okay, so we're seeing some sort of separation here. There's some speed, and then a quick jagged reversal through the standard percentage K reading, or just the standard stochastic line, the red line. And that crossover is giving you a good indication that price action
slowing down.
Is actually speeding up. So we're getting more momentum. We're getting more momentum, like here. It's crossed over the red line, and boom, you're seeing a lot of speed. Let me get the crosshair. The crossover's here. Once it's crossed over, it's an indication to start buying on the low end, on the low side, because it's also close to 20. It's on the lower end here, in the lower range. You can see it again here as well. And here as well. So when the blue line crosses over the red line, you're seeing an increase in momentum, and
which you see on the big candlesticks,
of course,
the larger candlesticks.
You're seeing this big price action here, and then we get up into an overbought sort of price above 80. That is, so stochastic readings are now above 80. So we're in overbought territory. It's giving us that reading, and we're seeing a crossover again. We're seeing a potential sort of gain in momentum and speed in price action, and we are seeing that reflected in the prices until we're getting into oversold territory. Now, don't sort of confuse. Yeah, it is showing overbought territory. It is showing oversold territory, but this is more about the crossovers. This is what gives you the signal to buy or sell. Okay, these crossovers. Don't focus too. It is important, obviously, to be aware that we're in sort of overbought territory. It will give you a stronger indication when there's a crossover in overbought or oversold territories that there will be a reversal. Okay, so this is a leading indicator. Okay, as opposed to lagging indicators like moving averages. Okay, so these crossovers, or these diverging or converging sort of crossovers, they are giving you sort of, the stochastic oscillator generates buy and sell signals. Okay, so it's very, very useful to learn how to use it and get your head around stochastics. Really, I just want to make sure I've covered everything I wanted to cover. So yeah, it's more sensitive to momentum or speed of price rather than actual market price, and yeah, that's where it differs from relative strength index. And of course, it's one more thing actually. Now, what I want to mention here actually is that it's also used in regards to the prevailing trend. So let's say we're in a downtrend here. Okay, so basically, if we're in a downtrend, okay, and we're seeing sort of lower, let's say, let me find a good example of this. Okay, all right. So we're seeing lower highs here. Okay. Now, what we want to see for a very good sort of indication that there will be a reversal. Okay. So there's a divergence. Let's say here we're in a downtrend, and the crossover and the peak of the stochastic, okay, in a downtrend is high here. It's at 80, okay, but the crossover here is lower than 80. It's more like 60 or 70, okay. So we're seeing you know, we're seeing again another reversal, but there's a divergence now in a downtrend, that we've got this reading here at around 65.70 where the crossover is, and the prevailing downtrend is a downtrend, it's bearish. Now we're seeing a divergence of the crossover, okay, so now we're seeing a higher reading in a downtrend, prevailing downtrend, but now we're seeing a higher high on the stochastics. Okay, so this is a divergence of the stochastic.
Higher high, you just mean like the higher level. So before we had like 80, and now it's
more close
90,
to 100.
93.
Yeah. So in a downtrend, we've got our high. Let's take here, for example, which is like 70 in a downtrend. But now we're seeing a crossover at 92, which is a divergence against the actual price. Okay, so it just means that we're seeing a higher high on the stochastic, all right, when all we've been seeing is lower highs.
What does it mean? It's showing that there might be a switch of trend, or
it's a strong indication of reversal, essentially, which is what we've
because
seen.
if I look at the channel of this downtrend, then this high actually broke through the upper resistance level on the channel, if you draw the channel.
Where exactly? You mean?
Well, like from the highest high in the downtrend, and then you see sort of the getting out of the channel. So
yeah, I mean we're looking very very long term here on a day chart. So let's have a quick look at on an hour chart and see if we can find divergence between the stochastic and the actual price action. Okay, so all right, so let's have a look at this move here, this upward move. Okay, very sort of upward direction. So we're getting higher highs of the price, okay, higher and higher on the price action is what we're looking at here on the candlesticks. But what we're seeing is a divergence. So we're seeing crossovers, let's say lower and lower. So this is doing the opposite, but the crossover is at you know, this level here, and then it's lower here. So it's showing an even stronger indication of reversal. So this is divergence. They're doing opposite. So it's not following the higher highs on the candlesticks. It's actually lower lows on here where we get in the crossover. That's what I mean by divergence of the stochastic versus the price action on the charts.
well, if you had to give a very easy explanation for the beginners, how can they use it?
Okay, well, in very very simply, you know, when using stochastics, what you're looking for is this blue line, the 3-day moving average, or the percentage D, to cross over the red line, which is giving you an indication of a reversal. Okay, which it did here. It crossed over here, and okay, it didn't work perfectly here, but we wait again here. We see a crossover, and okay, there was a little upward spike, probably some fundamental data, but then now, this is what I mean by leading indicator. The crossover is here, 1, 2, 3, 4 hours before a big downtrend. So this is what I mean by price speed. It's reacting more on momentum. It calculates more. The calculations are done more about price speed. That the speed is price action is speeding up. There's more momentum, and there will be a crossover here and a big reversal. And again another crossover here, and you're seeing more big downtrends here. It works perfectly here. Blue line crosses the red line, sell. On the other side, blue line crosses it at the bottom, the other way up, then good time to buy. Very simple.
Yeah. Okay.
All right.
Let me just have a quick look if we have any questions so far. If you have any questions, just put it into the chat. Right now there is nothing open. Okay, good.
So we're going to move on to moving average convergence and divergence next, or MACDs as they're commonly known.
First question, what is the difference between the other moving averages? Well,
okay, so look, moving average convergence divergence MACD is a calculation of it's calculating 26 period moving average minus a 12 period moving average, which is then that's what gives you the MACD. Okay, so it's a formula of two different moving averages, which is what gives you MACD, and then it produces a signal line as well.
And why can't I just use a 14-day moving average? I mean, like if I have 26 minus 12.
Well, no, it doesn't work like that. It's essentially it's producing. It's taking one moving average and another moving average and making a formula. Okay, so it's essentially 26-day exponential moving average. Subtracting a 12-day moving average, okay, is not just going to give you a 14-day. That's not how MACDs work. It's just not. A 14-day moving average would be something different. Okay, so essentially, what you're ending up with as well from doing this calculation, and by using MACDs, you also end up with a 9-day sort of EMA as well, which is what we call the signal line. Okay, so let me just plot it on our chart here. All right, and we'll be able to see. Let me just minimize the stochastics and maximize our MACD. All right. So what you're seeing here, the MACD can sometimes be shown as a histogram, like a bar chart. So you're seeing these white bars. This is our MACD. The red dotted line is our signal line. Okay. Now essentially what we're looking for using MACDs, let's take the current sort of price right now. What we're looking for is, now this is a lagging indicator, okay, so it's not giving you a very good like foreshadow or foreseeable future. It's lagging, so it's more long term. It's to be used slightly more longer term, but it can be used to give you an indication where to buy and where to sell, obviously. So what we're looking for essentially is MACDs. Now remember, the MACD is the white bars, silver bars, and the signal line is our red dotted line. Okay. Now what we're looking for a buy signal is for now a crossover again, a divergence or a convergence on the upside. This is our baseline here at 0. Okay. Now we're in bullish territory when it's above the baseline. All right. So it's above 0. All the readings are above 0. When the MACD is above 0, we're in bullish territory, so we're moving upwards. Okay. Now let's look at the crossover period, or the time where it crosses over the signal line. The MACD has crossed over the signal line and as you can see, we're getting a lot of buying action. Okay, now it's crossed back down through the signal line. We're not seeing a big sell-off, but we're still in bullish territory. We're still above the baseline. Okay, so what we're looking for again for another buy signal would be for the MACD to cross back over the signal line, which is what we get here. Let me get my cross here, over here. So we're getting a crossover of MACD over the signal line. The red dotted line is being crossed over by MACDs. Okay, and obviously you're seeing a
Just
good
go back
good buy
on
price.
the one where it crosses. Yeah, okay.
Yeah. So the MACD is crossing through the red dotted line, the signal line, and we're getting upward price action. Okay. Now it's indicating, you know, market volume as well. Obviously, the MACD indicates market volume. The higher we are, you know, the higher the readings are above the baseline of 0. Okay, so I mean here we've got a reading of sort of you know 0.0014, let's say, for instance. Higher readings here, 18, signal lines, you know, but the higher the reading you're seeing above the baseline, the more volume there is in the market, and you know, slowly market volume decreases, and we could, as you're seeing it decrease, you should start thinking, all right, maybe it's a good time to start looking for a sell, you know, a sell trade. So again, it works the opposite way. Now we're approaching the baseline, so we're approaching 0. The MACD is approaching the baseline. It's crossed through the signal line, and we're getting sell bearish action and downward sort of price action on the charts here. Okay, and once again, it's below the baseline, so we're in bearish territory, we're in negative territory, downward price action, and we should start looking for, you know, opportunities to start buying into the market. So we're going to start looking for the MACD to start crossing or breaking through, or you know, the signal line. Where we get here doesn't quite break through properly. We get it again here,
and there it breaks through.
Yeah, and now we're getting bullish price action. Okay, so based on that breakthrough, you can see it's tried to break it just here. It doesn't quite work. It's gone a little bit lower. So we're in oversold territory, and now we've got a crossover again. So yeah, it's a good indication to start buying. But we're looking at thin volume here. Now, thin volume is it can be quite confusing for people, because thin volume can mean you know, nobody's in the market, nobody's trading. But when you have really thin volume, it's inevitable that volume will pick up, and there's going to be a snap in one direction or the other.
Okay.
Or there's going to be a breakthrough. So when looking at thin volume, you're going to get these big candlestick movements in thin volume sort of time periods. Anything can cause the breakouts, fundamentals mainly. News events or data points, economic data points and things like that can really shift the market sentiment, and then thin volume, bang, you get a really big price movement. But again, you can see it working very effectively here. You know, the MACD is moving through the signal line here, and we're getting bearish action below the baseline. Boom, it's crossed all the way. Signal line's gone all the way through. There's a little bit of separation here, and we find these gaps is where you're getting the price action. So the sort of the further the signal line gets away from the MACD, inevitably, you know, this is where you're going to find some reversals. You're going to find some reversal sort of price action. And again here we've got you know, a big bearish move today on euro dollar, and you can see the MACD is crossed through the signal line. So yeah, yeah, that's essentially how moving averages work. You've got a 26 period EMA, or exponential moving average, subtracting a 12-day period EMA, and the result of that calculation is the MACD line.
Okay.
So then you plot a 9-day moving average, which is the signal line, and that's plotted over on top of the MACD. So that's how you use it. Let me just make sure I've covered everything I wanted to cover. Yeah, that's pretty much it for MACDs.
Okay, do we have any questions so far? Just type it in the chat, or we can also give you the voice at the end, the open Q&A session, so you can talk with us and ask your question live. Just make sure your microphone is activated. And yeah, we will continue. Just type your chat, and we can jump to that also a little bit later.
Absolutely. So what we're going to move on to is Fibonacci retracements. Okay. So let me just minimize and drag all of this down. And we're going to plot some Fibonacci retracements. I'm going to go on to a day chart. Now, okay.
Just quickly, before we jump into what is it doing in the easiest way you can explain it.
Okay. Alright, so it is plotting support and resistance levels based on percentage levels that are calculated from the Fibonacci mathematical sequence, also known as the golden ratio. Okay, so it's you know, I can go into way more detail about Fibonacci numbers and the number sequence.
No, we keep it simple.
Well, we're just going to keep it simple. Okay. So essentially, what you want to, the way that you want to use Fibonacci's, you've got it here in your tools bar, okay, in MetaTrader 4, next to your trend lines, support and resistance lines.
And it has a small f for Fibonacci.
Yeah, very well spotted there. So what we'd like to do is find support and resistance levels, and how to you know, get indications, you know, to buy or to sell using these levels.
And
so
you start drawing with the highest point on your chart and pull it down to the lowest.
That's right. That's right. Because this is a prevailing downtrend. If it was an uptrend, I would have gone from the lowest price to the highest point. But in this case, it's a prevailing downtrend, so I'm looking for the support and resistance levels based on this trend. Okay.
Well, if we look at the first, well, not the first, but the second, then it matches pretty much. It's a support level, and after breakthrough down and recovered up, it's sort of a resistance level.
Yes. These are okay. So we've got our 100% level, okay, which is where we're starting from. Okay, and then we've got our 0% level, which is obviously the top and the bottom of this trend. Okay, now what we're trying to spot here is we're going to use this retracement level, the 61.8 level, as a support level, which it does work. Is this what you meant? You meant here, yes. So
and then later it becomes the resistance level.
It does do, yes, but it's worked successfully twice here. Once it's worked for a good indication to buy, so we could have done that. Bought very nicely there, made some nice profit, and then it's retested it here and worked. So it's tested the Fibonacci level again. Now it's come down and tested it. Hasn't quite worked as well. Broken through to the 50% level. Now 50% is technically not, mathematically is not actually in the Fibonacci sequence, but it is in trading. We use it in trading. It's more related to Gann theory, and that's a totally different topic. But 50% retracement level is just very important in trading. But we use it in Fibonacci's because of its importance. So it's come and it's tested the 50%. As you can see, you know, it's right bang smack in the middle, 50% from the top and the bottom of this trend. So it's worked not amazingly well. I mean, it's been tested. There was a spike up, spike back down, very volatile day here, but then we're just seeing it sort of being tested. So we're just testing here and broken through down to the next level. And we've seen a little bit of upward action, but not much. The next day has opened, and we're still in a downtrend, but retested this level. So now we're using the 38.2 level or retracement level, 38.2% retracement level, which has worked extremely well as a support level. Okay, so a buy trade here would have been extremely successful. It would have taken you up 1, 2, 3, 4 days worth of upward, or 4 days worth of profits, let's say. And now this 61.8 level is being used as resistance. Okay, so it was support here. In this case, we've had a lot more sort of downward action, bearish price action, and now we've moved back up. It's retesting this level here as resistance now. So we're getting a little sort of just a lot of testing for 5 or 6 days here, maybe for 1 week. It's just testing, but then eventually it does work, and it is effective as a resistance level, and we get our desired sort of price action. And this level would have been, you know, when we're using Fibonacci's here, you're kind of considering, oh, you know, it's testing the level, it's testing the level. This is now resistance. But you're not quite sure. You know, you could be saying, right, it's going to break back up to 100. Yeah. You know, so it's important to, you know, maybe put a stop loss somewhere logical. You know, based on whatever you're comfortable with, or based on a risk to reward ratio, which we've covered in previous webinars. So it's important just to be aware of the fact that it might break through. It might break through. So, but in this case, it's a good resistance level, and has come way back down. 3, 4, 5 days of bearish action, and profits would have been very nice using this level here. So then again, we're testing this level again as support. So it's the third time testing, and it has bounced back up to this level. Hasn't broken through. Probably, you know, just now it might be an idea to use other indicators in conjunction with Fibonacci's, because Fibonacci's is really most effective in a ranging market, but you know, it's obviously, you know, also effective in a trending market. But you know, if you were getting confused whether or not, you know, the price action would break through this level, Stochastics could have given you a good indication at this stage that it's you know, price speed is picking up, price momentum is picking up. There's a crossover here. It's sell time. It's time to sell. So that would have been a good confirmation. So to use all of these indicators, you know, learn them one at a time, study them one at a time, master them one at a time, but you'll get to a point where you're able to use them in combination, in tandem with each other. So one will confirm the other, and you'll get a better idea of where the price action is going to move.
Well, if you just drop the moving averages and the Bollinger Bands onto it, would it make sense to use all of them, or would you say you're using a specific of them?
You can. I mean, you can start, you know, using many different indicators at once. Now we've got Bollinger Bands on the chart, and this helps here. Bollinger Band helps here. We've got a cross or a breakthrough of the Bollinger Band, so we could be saying, okay, now this is a breakthrough. It's oversold. we're using stochastics. It's at
And
20.
there
It's
is also
oversold.
yeah.
And we've also got sort of, okay, this is a lagging indicator here with MACDs.
And this is, I think, a day or two later when it's almost breaking through. Yeah, but
Yeah,
the Bollinger Bands in that way, and also stochastics would work.
yeah, I mean, the cross through here, it's at this point on this day. So the cross through, yeah, because we've already seen upward action. Okay, so the MACD is the MACD hasn't crossed through its signal line yet, but it has done a day before this huge move. So if you've got the patience, you know, for MACD to really confirm that you know, this isn't just a little test of this Fibonacci line, and it's going to start coming back down. The MACD is actually a good confirmation that we're going to get a bigger move to the upside. Okay, so again here we've got a crossover on stochastics.
I see, but probably if for a beginner it might be overwhelming if you had to cut it down to your most. I mean, we're already talking about the essentials. I understand. So these 6 indicators are the most essential ones. Which 2, 3 are the ones you're using the most?
Moving averages, Fibonacci's, and either stochastics or relative strength index.
Okay, and that depends probably then on the day and the situation in the market, if you take stochastics or... Okay, so show us quickly in that scenario which indicators you would use, and just explain us quickly what you would read out of it.
In the current situation?
Yes.
Current market price right now. Well, okay, well, look, I mean, you ask me to pick 3, and you know, it's difficult because
just take all of them, or take all of them. I think you're missing the moving averages.
Yeah, well, look, you know, it's important to get indications from as many sources as possible. Okay, so we're going to put our Swap Hunter moving averages, assorted moving averages here. So we have our 20 and 50, 100, 200.
So what I see now, the 50 just broke through the 100, which we discussed last week.
That's right, yes. The 20 is breaking through the 50 here. So 20 is breaking through 50.
Also broke through the Bollinger Bands shortly.
You mean here?
No, later on that.
Well, this is the upper Bollinger Band.
Yes.
This is the lower Bollinger Band here. We've got the 20-day moving average breaking through the lower Bollinger Band here, which is a good, you know, crossover indication of a buy. It's giving us a buy signal. You know, it's also sort of on a daily chart. We've tested this this Fibo level. Again, it's retested this level here. It's tried to break through the 20-day moving average. I'm not seeing a convincing breakthrough, so I would have said I'm going to go for a buy here. And
but now we see it's testing the 38.2 Fibonacci line at the last candlestick.
Current market price, yes, it's now testing the 38.2% Fibo retracement level. So, I mean, what in this situation, it is looking pretty bearish. To be honest, it is looking quite bearish. We've tested this level a couple of times at the 50% retracement level, and we've seen a considerable move and breakthroughs the 38.2 and even the 23.6 level. You know, back up to 38.2. And then back right through 23.6% and right down to 0%. So this could be an indication of a much stronger dollar, much weaker euro, and the euro dollar could be heading further down.
What I see also is that the MACD is also breaking through the signal line, through the...
It's just, well, let's see, it's just about to sort of break through the signal line, but I think this is more to do with market volume. It could be an indication that if the next MACD reading is an even stronger or higher breakthrough the signal line, then I would say, okay, we should start looking at considering buying here. But we've had this strong stochastic breakthrough, which maybe we've seen the bearish action already. You know, it tested the 200-day moving average, which is a very strong test. It's broken through the 50-day moving average, which is showing me very bearish action. But it could stall here. Nothing goes down forever, and we have seen this level successfully being tested and people buying off the 38.2% level. I would probably take a guess based on the fact that it's broken through the 50-day moving average, that we'll see a little bit more downward action, and it'll test our this is our 100-day moving average, and if it's broken through, and if it hits the 50-day, it will probably test this 50-day moving average, I would say, unless we see Bollinger Bands and everything crossing through, because we do have a cross through on the 20-day moving average through the 50, and we could see a very quick reversal back to the upside now, because we're looking at fundamentals you have to consider as well. We're looking now at the Federal Reserve meeting at the end of this month, the FOMC Minutes. They're going to probably cut interest rates again, which will probably mean a weaker dollar, which will probably mean a stronger euro dollar, because a weaker dollar against the euro means that this exchange rate will go up. The euro will get stronger against the dollar. And yesterday we had the monetary policy meeting from the European Central Bank, where they could have cut rates, but they didn't. They left rates at zero, interest rate at zero. So no changes there. And maintaining an interest rate is technically, or fundamentally, it's a bullish. It's a bullish piece of data.
Okay. So did you cover everything now with the Fibonacci as well? Then
yeah, I mean, just to summarize, essentially what you want to be doing, the way you want to set it up, is take your Fibonacci, click on it, and then you sort of click and drag from the highest point to the lowest point, and there's no calculating needing to be done with Fibonacci's. It's all done for you. All your levels are calculated for you. And yeah, that's essentially it. Just use the lines as support and resistance levels, and that's where you're going to get good ideas whether to buy and sell based on these percentage levels.
Okay, good. So yeah, thank you very much.
Pleasure.
If you have questions, put them in the chat. If you don't manage to reach us in the time of this webinar, you can contact us on Facebook, through our webpage. Yeah, we have different channels. Just subscribe and follow us, and then you can definitely get in touch with us. We'll keep it open a little bit longer, so if you have questions, just type it in the chat. We will answer it. And yeah, thank you very much for your time. And let's quickly cover Forex Cube, which we recommend as our Forex broker.
Yes, fantastic brokerage, a true STP ECN, that's straight through processing brokerage. You've got up to sort of 1 to 400 or 400 to 1, depending on how you want to say it, leverage, ultra tight spreads. Your funds are deposited up to $20,000. Instant deposits, withdrawals, very safe and secure banking sort of methods and solutions. and we do partner with them because of their sort of fantastic execution speeds, trading execution speeds. No, you're not going to find any slippage there or anything like that. And like I said, you know, if you get an account opened with Forex Cube, we have a promotion running where we'll give you Swap Hunter, the Swap Hunter indicator package for free for 3 months. So do get registered, open a demo account if you're not ready to go live yet and start trading with real money. And yeah, we'll see you in the next webinar. Check out all of our social media channels, Facebook, YouTube, Instagram and Twitter, and we'll see you in the next webinar.
Thank you and goodbye.